What's up, everybody? It's your boy Satt coming to you with today's stock pick, news, and indicator help. No face, just facts in 5. I do the research, so you don't have to. Make sure you check out the new StocksBySatt06 live stream, where we keep a live feed running on some of the top stocks and indices in the market. Shout out to 11 Labs for making every video possible. Today we're talking about Netflix's upcoming earnings. The company reports Q2 2026 earnings on Thursday, July 16th at approximately 1:01 p.m. Pacific, followed by its earnings interview. This report could move the entire streaming sector and give us a read on consumer spending, advertising, and entertainment trends. This matters because Netflix has evolved far beyond being just a streaming company. It's now a leader in subscription media, digital advertising, original content, and even live events. Investors aren't just looking at earnings, they're seeing if Netflix can continue delivering the growth that justifies its premium valuation. The numbers and guidance released this week could shape sentiment for the rest of the summer. Here's a Q2 preview. Revenue growth remains a major focus as Netflix expands 7% year over year. Subscriber growth is expected to be healthy following the success of its paid sharing initiative, increasing year over year by 9%. Operating margin has improved by 27.2%, and operating income has gone up by $10 billion. Next up is Analyst targets. Although Morgan Stanley, Barclays, and KeyBank trimmed their price targets, the overall consensus remains bullish. The average target price still sits at around $110, showing a 49% upside, with 20 out of 30 analysts having Netflix as a strong buy. So these target reductions appear to be more about managing expectations. Another major storyline is the newest growth engines. The ad-supported subscription tier continues expanding and gives the company a completely new revenue stream. At the same time, Netflix is making a serious push into live programming through sports and special events. Recently, live streaming the MLB Home Run Derby exclusively on Netflix. If these initiatives continue gaining traction, they could significantly increase user engagement while opening additional advertising opportunities over the next several years. Okay, let's talk about what options traders are expecting. Right now, the options market is pricing in roughly an 8% move following earnings, which is larger than the company's recent average earnings reaction. Interestingly, call volume continues to outweigh put volume, suggesting many traders are positioning for a bullish surprise. That doesn't guarantee the stock goes up, but it does tell us volatility expectations are elevated heading into Thursday's report. Here's the bull case. Netflix continues executing at an incredibly high level. There has been strong revenue growth of 7%, improving profitability with a 2025 operating margin increase of 27.2%. The ad-supported plan is scaling extremely fast with $3 billion in projected revenue. It continues to churn out blockbuster exclusives and original programming. They have procured more live sports and events and shown early success with key stakeholders like WWE and MLB, and continues to have a global advantage over its competitors, adding 302 million subscribers year over year. But here are the risks. A solid quarter could disappoint if guidance comes in below estimates. Subscriber growth could slow. Advertising adoption may take longer than expected, content costs continue rising, and competition from Disney, Amazon, Apple TV Plus, and YouTube remains fierce. Add in currency fluctuations and broader economic uncertainty, and there are plenty of reasons for investors to remain cautious despite Netflix's strengths. Now, let's pull up the chart. Technically, Netflix is sitting at a great level heading into earnings. On the one-year chart, price remains below both the 50 EMA and the 200-day moving average, confirming the longer-term trend needs improvement. The stock is currently testing an important support area around $68 to $70, while resistance sits near $78 and then around $85. The relative strength indicator has recovered from oversold territory, but still leaves room for movement in either direction, while the MACD has improved from recent lows without fully confirming a bullish trend. Simply put, earnings will likely determine whether this becomes the beginning of a breakout or another rejection lower. Here's Satt's take. Netflix earns an 8.5 out of 10 as a long-term growth play. I still believe it's one of the highest quality businesses in media. The company continues building multiple revenue streams through subscriptions, advertising, and live events while maintaining exceptional global reach. However, investors should remember that execution has to remain nearly flawless because expectations are elevated. This will be a report card on whether Netflix can justify its valuation heading into the second half of 2026. Remember, I'm not a financial advisor, and this is not financial advice. Do your own research, manage your own risk, and never invest what you can't lose. Don't forget to smash that like button, subscribe, and drop a comment with a stock or earnings report you'd like me to cover next. This is Satt, and I'll catch y'all in the next one. Peace.